All right, folks, let's take a look at some questions from Chapter 8. So in this one, notice what happens. They want you to calculate interest, right? So here we got calculate the missing number. And here's the missing number right over here. So we got $100,000, 10%, 6 months interest. They want to calculate that number, and it turns out to be $5,000, right? So all you got to do is multiply that straight across. The next one's a little bit more challenging. They tell you, well, the interest is $3,000. They tell you how much money it was, and then they tell you how long it was. And they want to know, well, what was the interest rate? That's what they want to solve for. So you see, this 9/12 right here, that's 9 out of 12 months. So when you take $50,000 multiply by 9/12, you get 37,500. 3,000 divided by 37,500 gives you 8%. And over here, they give you the interest that was earned. They tell you it was 10%, and it was for a whole year. And they go, well, what would the number be that 10% interest would be for 1 year? It would be $4,000, and you can see 40,000. Not too challenging, just use that simple relationship, typical algebra type solving, okay? All right, next one. Here we're talking about brown cow dairy using an aging approach, right? So they're telling us we want to estimate bad debt expense. So for 1 to 30 days, they got $12,000. For 31 to 90 days, $5,000. And over 90 days, $3,000. And experience has shown them, so they give you the rates, 5% for the first one, 10% for the second one, and 20% for the third one. And then at the end of the year, the allowance for doubtful accounts was a credit of $800. That's what this is showing right here. Now remember, the allowance for doubtful accounts is a contra asset to accounts receivable. That meant that they had $800 left in here that they didn't use, okay? So basically they had overestimated last year by $800. So they want you to go and do the year-end, all the things having to do with this. So let's take a look at how we do that, okay? So the first thing, you take the numbers and multiply them out, right? So the 12,000 they said at 5%, that's 600. 5,000 at 10% is 500. 3,000 at 20% is 600, right? So this is the amount that you should have, that they need to have in their account. And they already have $800 in there. So the question is, how much do you have to add to it? You have to add 900. So what they do, there's the adjusting entry. Let me move my picture up here, right? And what we do, so here it is. What we would do here, we go bad debt expense, 900. This is the journal entry. And ADA, 900. So there we are. We're putting that $900 into the allowance for doubtful accounts, right? This is requirement number 1. And then requirement number 2, what was number 2? Number 2 said, what if it was $600 instead of $800? Well, if it was $600, then what would happen? We would have to, if it was $600 debit balance, and we still needed to get to this $1,700, we'd have to put 23 in. So you see the balance that was in there is part of the calculation to see how much we had to put in. Here, because we had $800 left, we only had to put in 900. But here we had to get to the same 1,700. But actually here, the year before, we did not put enough money in there. So we have to put even more this year. Okay? All right, let's see this one here. Again, we have used percentage of credit sales method. So here they're using percentage of credit, and then they're using both percentage of sales credit and then aging receivables. Okay, so they want you to do it both ways. Okay, and you can see the information is here. Okay, so the first one, requirement number 1. Oops, let's go back here. Okay, so they had $89,000, right? And they had credit sales of $100,000 and 1/2 of 1%. So the first one that they wanted you to do was to do it with the credit. So 1/2 of 1% of $100,000, it's $500, right? That's this one right here. So you have bad debt expense at expense and account, and here's your contra asset for 500. This was the first way to do it based on percentage of receivables. Now, the second way they're switching it over now, they said they had $89,000. They had $89,000 in receivables. Of that, $75,000 was at 10%. Again, they gave you those numbers. $10,000 was at 20%, and $4,000 was at 40%. When you tally those all up, that's $11,100. Okay? Again, they're just making these up. So, if we need to have $11,100 in the account, $11,100 in the account, and we only have $1,600, there's the adjusting journal entry right there. Okay? Now, accounts receivable, what it would look like. So on the balance sheet, okay, this is actually the proper way right here. On the balance sheet, it would say accounts receivable. It would show $89,000. Then here's less that allowance, $11,100 for net $77,900. By the way, that's a tremendous. Can you imagine selling almost $90,000 worth of stuff, and you don't get 11,000 of it? That's crazy. That's not business. That's insanity right there. Okay. All right. Next, we're going to take a look at some. It says here we got some effects of write-offs, recoveries, bad debt expense. Let me move my picture again. All right. So let's see what we got. Make sure this thing ain't going kablooey. Okay. Customers were billed for detection services totaling 25. Oh, it's going bluey. Just told you don't do that. Okay, I want my highlighter. Okay, there we go. $25,000. 10 customers were billed. A customer balance of $1,500 from a prior year was determined to be uncollectible and written off. Okay. A customer paid an old balance of $900, which had been written off in a prior year, and on December 31st, $500 of bad debts were estimated and recorded for the year. And they want us to go through and prepare all this stuff for Fraud Investigators, Inc. Okay? So, the first one, all we're doing here is showing the account receivable and the service revenue. So that was the very first one, the $25,000. Okay? Now the second one, it was allowance for doubtful accounts. And let's see, what did they tell you? A customer balance of $1,500 for a prior year was written off. Okay, so when you go to write that off, notice we have to credit the account receivable. We have to take it off the books. We have to credit it. And we use that allowance, $1,500 out of the allowance for doubtful accounts. Remember, that's a contra asset. Now, the next one, they said they collected money from somebody that had owed them money from the year before. So the first thing they got to do is put it back on the books, right? Because remember, it's not on their books anymore. So they put it back on the books, and then they put the money back to the allowance for doubtful account, right? They have to put it back into that account because now they're actually collecting the money. That's the first part, putting it back on the books. Then we can collect the cash, and then we take off the account receivable, okay? But you have to put it back on the books in order to show the payment, okay? And then finally, bad debt expense. All they wanted you to do is just to list the bad debt expense here, $500, and allowance for doubtful accounts. Of course, this is the one they're just estimating here with this one, okay? All right, folks, that's it for Chapter 8. Make sure you print those out. Make sure you understand. If you don't understand, make sure you ask questions. All right, folks, that's it. We'll be back with Chapter 9 in just a little bit.